So, let's talk about September 3rd. It's like the global financial market woke up with a serious case of split personality. One half of the market was absolutely screaming fear, while the other half, well, it was surprisingly optimistic. Today, we're going to dig in and try to decode what in the world was happening.
Okay, so picture this. On one side, you had a historic sell-off in government bonds, the assets that are supposed to be the safest on the planet. And right on cue, gold, the classic safe haven, soared to record highs. Those are textbook signs of panic. And yet, at the exact same time, major stock markets in the US and India actually rallied. Confidence in the face of pure fear.
So yeah, that's the big puzzle, right? How can both of these things be true at once? How can you have a full-blown panic and a party happening on the same day? What's really going on here?
All right, to get to the bottom of this, we got to start with the fear. And that fear, it all comes back to government bonds, the supposed bedrock of the entire global financial system. Well, on this particular day, that bedrock looked like it was starting to crumble.
And if you want to know how bad it was, just look at this number, 5%. The yield on the 30-year U.S. Treasury bond, which is a benchmark for the entire world, was creeping up towards that critical level. That is a huge, flashing red light signaling some deep, deep distress in the government debt market.
And look, this wasn't just a US thing. No way. This was a full-on global contagion. Over in the UK, yields hit levels they hadn't seen since 1998. In Japan, since 1999. All across Europe and Asia, the story was the same. Investors were just dumping government debt.
So you got to ask, why the sudden panic? Well, the reason is actually pretty straightforward. Governments all over the world have racked up an absolutely staggering amount of debt, especially since the pandemic. And now, the market is starting to get seriously nervous, questioning whether they can actually afford to pay it all back.
Okay, so if investors are suddenly terrified that government bonds aren't so safe anymore, where do they run? Where does all that nervous money go when it's looking for a real safe haven?
The answer? Gold. It just exploded to a new record high. We're talking over $3,500 an ounce. It's a classic move. When trust in governments and their currency starts to wobble, investors flock to the one asset that's held its value for thousands of years. But here's the kicker. This isn't just about regular folks buying gold coins. Oh no, something way bigger, something truly historic is going on behind the scenes. For the first time since 1996, the world's central banks, the biggest players in the game, now hold more of their reserves in gold than in U.S. Treasury bonds. Think about what that means. It's a massive, strategic move away from the U.S. dollar as the world's go-to asset.
All right, let's recap. We've got a bond market in a total freefall and a historic stampede into gold. The story should be over, right? Fear wins, end of story. Except, it wasn't. Now we have to flip over to the other side of the market's brain, where some investors just decided to completely ignore all the flashing red lights.
And to really get how bizarre this rally was, you have to know about something called the September effect. It's a well-known thing on Wall Street. Statistically, September is the absolute worst month for stocks. The S&P 500 has averaged negative returns this month for almost 100 years. So for stocks to actually go up in this environment, that's just doubly strange.
So what gives? Well, it turns out the reason for all this optimism came down to some very specific, very local stories. Here in the US, the communication services sector got a huge boost thanks to a massive 9.1% surge in Alphabet stock after a good legal ruling. And then over in India, the metal sector was flying high on hopes for tax reforms and better steel prices. These were powerful local stories that just managed to drown out all the global doom and gloom, at least for one day.
And that India story, man, it was just on fire. It was fueled by some ridiculously strong local economic news. Their services sector activity hit a 15-year high, and everybody was betting that a big government meeting was about to deliver some very friendly tax changes. It was just a perfect storm of local good news. So we're left with these two completely opposite narratives, right? Global fear fighting local optimism. But there's one more piece to this puzzle. The one thing that, believe it or not, ties it all together, and that's the U.S. Federal Reserve. Okay, here is the absolute best way to understand this. The bond market is shouting from the rooftops that the entire financial foundation is cracking under the weight of all this debt. But stock market investors, they're not running for the hills. Why not? Because they are absolutely convinced that the world's best repair crew, the Fed, is already on its way, with a big truck full of cheap money in the form of rate cuts. And listen, the market wasn't just hoping for a rescue. It was absolutely certain.
Traders were pricing in a mind-blowing 98% chance that the Fed would cut interest rates at its very next meeting. For the market, it wasn't a question of if the Fed would step in, it was just how soon.
And you know what? This wasn't just wishful thinking. The Fed itself was dropping some serious hints. I mean, when a top Fed official like Governor Christopher Waller basically comes out and says, quote, the FOMC should be cutting the policy rate now, well, you better believe the market is going to listen. That's about as clear a signal as you can get that help is on the way.
So, what are we left with? A market that's in this incredibly fragile, unstable balance. It really is like watching someone walk a financial tightrope, with these massive forces pulling them in opposite directions.
Think of it like a giant tug-of-war. On one side of the rope, you have all these massive, scary risks: global debt, a bond market that's freaking out, and the whole September curse. But on the other side, you have this incredibly powerful hope, the hope that the Fed will come to the rescue, all propped up by some great local news. This is the battle that defined the day.
And that brings us to the ultimate billion-dollar question. What happened on September 3rd set up this massive collision course? You've got crashing fundamentals like the bond market's warning, going head-to-head with the unbelievable power of a central bank. Sooner or later, something has to give. The only question is, which one is it going to be?